Okay, good evening, everyone. I hope you people are doing well. So welcome to the session. We are going to start off with the SBR. And as I mentioned to you people that my agenda of these sessions is I want to do the maximum exam practice questions on the SBR. The unfortunate thing is that these days ACCA's CB practice platform is not responding well. So because of that, I have to use the revision kit. I am not very much happy with that. But rather than not being able to teach and it's better than actually we use the revision kit and we go about doing the questions. So what I have done is that I've taken in front of me a Kaplan revision kit, latest Kaplan revision kit. Unfortunately, not all of the examination questions have been amended as per the latest examination format. But again, whatever that has been amended, we are just going to go through them and we're just going to go through discussing all of this. So let's just start off. Let's just start discussing this. What you have in front of you is basically an examination question from one of the past papers. The name of the question is Sterling Company. The Sterling Company question is from one of the ACCA past examination of September 2022. Now let's just see that what has been covered up in this Sterling Company and how would we be able to cover up the Sterling Company. Let's try to discuss this. So first of all, this is one of the questions, which is question number one. Obviously, nowadays what the examiner does is that the examiner gives you a pre-populated spreadsheet for the question number one. So we're going to go through that also, and we're just going to see that what this exactly means. So this is one of the questions on the consolidations, the Sterling Company question. First of all, what I would do is that I would go through the requirement of the questions to see that what exactly are the requirement of this question. One of the requirement of this question is that it says using exhibit number 1, explain how Birdhold company will be accounted for, including the calculations in the consolidated statement of profit or loss for the year ended 31st March 2009. So you have to explain how Birdhold company would be accounted for in the consolidated statement of profit or loss. The second thing is that you have to explain and show how the goodwill in Birdhold company would be calculated, how the goodwill in the Birdhold company would be calculated at 1st December X8. Then using exhibit 2, advise directors with illustrative calculations how 30% of the investment in malting company should be accounted for in the Sterling company's consolidated financials. Then exhibit number 3, explain to the directors of a Sterling company how to account for batch company as a discontinued operation at 1st January X9. In a Sterling company's consolidated financial statement, your calculation should include the calculation of goodwill, calculation of investment should be measured prior to the disposal. Now, this is all that we have to do. Let's just try to understand this. Let's just try to go through it. So first of all, we have the first requirement, which is using exhibit 1, explain how Birdhold company will be accounted for in the calculations and so and so, so and so. Now what I'll just do is that I'll just try to copy this onto the Excel so that you people have an idea that what is actually going on. So it says using exhibit number 1, this is one of the requirement, and this is another one of the requirements. Now let's try to see this. So we have the requirement on the Birdhold company. So let's just see. It says acquisition of Birdhold company. It says Sterling company paid $25 million for a 40% holding of Birdhold company's 10 million $1 ordinary shares on 1st January X7, when Birdhold company's retained earnings were $18 million. Birdhold company has no other reserves. Sterling company exercised significant influence over Birdhold company's financial and operating policy decision making. So when you exercise the significant influence, that is considered to be an associate. What is that considered to be? That is considered to be an associate. Now what next is there? It says a further 35% stake in Birdhold was acquired on 1st December X8. So you originally had 25%, 40% shareholding, then you acquired another 35% stake, so it became 75% for $41 million. When the fair value of Birdhold's identifiable net assets was this, and retained earnings were this. The difference between fair value of the identifiable assets and the Birdhold carrying amount related to non-depreciable land. Market price of the shares immediately prior to 1st December 8 was this. Sterling Company measured the NCI at fair value. Birdhold reported a profit for the year ended of so and so. Now what is the requirement? Explain how Birdhold will be accounted for, including any calculations in the Sterling's consolidated statement of profit or loss for the year ended 31st March 2009. So if I could just have a quick discussion about this, let me just guide you that we would say that Birdhold Company was an associate till the acquisition of the additional 35% shareholding. The associate is not consolidated but rather accounted for using equity method of accounting. Under the equity method of accounting, what actually happens is that a single line item is shown in the statement of profit or loss, reflecting the share of profit from associate. Now see what is actually happening. You acquired this 40% on 1st January 7, and during the year on 1st December X8 you acquired additional shareholding. Profit for the year was 11.1 million. For the initial period starting from 1st April X8 till 30th November X8, the profit and loss would reflect the following: share of profit from associate 11.1 million, right? Is that what it is? Multiply by how many months? From April to November, 8 months divided by 12, multiply by 40%, right? So 2.96 million is going to be the profit, share of profit from associate. That's one thing that you would do. For the remaining 4 months, the investment has now become a subsidiary, and hence Birdhold Company should be consolidated. Sales and expenses for the 4-month period will be consolidated to the parent's sales and expenses. Not insufficient information is available, and on that basis a share of on that basis profit to be consolidated for 4 months will be so the profit will be consolidated will be 3.7 million. So if I could just zoom out and if I could just help you see the whole of it, which I have done, so that you have an idea that what is it that is we are gonna do. So see if you understand this. In case if there are any questions, do let me know on this, please. If there are any questions on this, please do let me know. Yeah, is everyone okay till now? Is everyone okay till now? Okay, now let's move a bit forward and let's discuss further. So basically now the second requirement is explain and show how the goodwill in Birdhold would be calculated at 1st December 2008. So in order to calculate the goodwill, the cost of investment shall be the fair value of the existing interest and the additional consideration paid to acquire the 35% shareholding. The non-controlling interest shall be measured at fair value and the market value of the subsidiary's share price shall be used to calculate that. The goodwill shall be calculated as follows. Cost of investment. The cost of investment is fair value of existing interest. Cost of further acquisition. fair value of NCI, fair value of net assets, share capital, retained earning, fair value adjustments. So if I talk about this, what would I do? I would say that originally we had 40% shareholding, 10 million shares were there, and the market value of the shares immediately prior to 1st December X8 was this. So what actually happens is that this is actually going to be 10 million shares multiplied by 40% because that's the existing shareholding. So it's like 10% 10 million multiplied by 40% multiplied by 9.2. Is that what it is? 9.2, right? Okay. So hence this is going to be 36.8 million. 36.8 million. Then the cost of further acquisition is going to be 41 million. Cost of further acquisition is going to be 41 million. The fair value of non-controlling interest is going to be on the basis of, again, see what actually happens is that you had 40% share, now you have 35% more. So actually 25% belongs to NCI. 25% belongs to NCI. With respect to fair value of net assets, although we know what the fair value of net assets are, so the share capital is 10 million. The retained earnings at the date of further acquisition was 42.3, and we know that this is going to be 55.3. So this is actually going to be 3 million is the fair value adjustment. Now you would say, how did you establish this 3 million? Just try to understand this. Basically, we know from the question that it is 55.3. We know from the question that this is 55.3. So hence resultingly what's going to happen is that you will end up calculating the goodwill of 45.5 million. How do we end up getting the goodwill of 45.5 million? Just try to understand this. Basically what's happening is that with respect to the computation of the goodwill, we have used the cost of investment 36.8. We have used the cost of further acquisition as this. The fair value of NCI is this. The share capital was 10, 42.3 was retained earning. The fair value adjustment was given. Let me know if you understand this, please. And in case if there is any issue with this, do let me know. Okay, lovely. Thank you, Ronald. Now, so basically, this is what you have got with respect to the goodwill calculations. Now, let's move a bit forward and let's discuss further. Let's talk about the second requirement of the question, which says that using exhibit to advise the directors of Sterling with illustrative calculations how 30% investment in malting company should be accounted for. So this is the second requirement. Now see, what I'll do is that I'll just open up the question in front of you, allow you 5 minutes. Can you just go through it in 5 minutes and see what you can do with respect to it? Yeah, can you just give it a try, please? Okay, let's just start off. It says on 1st July 2008, Sterling Company paid cash of 2.5 million and issued loan notes. Sterling Company paid cash of 2.5 million and issued loan notes with a nominal value of 1.1 million and a fair value of 1.3 million to acquire 30% of the equity interest of malting company. The remaining 70% is owned equally between two unrelated companies. All key operating decisions require unanimous consent of all three investing parties. Each of the three investing parties has the right to its share of net assets via a contractual agreement. Malting company reported a loss of 0.8 million for the year ended so and a dividend was neither paid nor proposed. All three investing parties provide separate guarantees to malting bank because of the malting's poor performance in the year. So what do you think that this should be, the accounting for this? Okay, let's talk. So basically what happens is that the entity's joint control is defined to be a situation where joint control is defined to be a situation where none of the investing entities is able to control the investee for any decisions to be made. It would require joint approval of all the investing entities. In the case of investment in malting company, in the case of investment in malting company, in the case of investment in malting company, none of the investor is able to make a decision on its own, and rather each of the investor is dependent on the others for the consent before a decision is taken. Such a situation indicates joint control, and hence the investment in malting company should be considered as a joint venture, and it should be accounted for using equity method in the group financial statements. For the individual / separate financial statement, the investment can be shown either of the cost or fair value through P&L, fair value through OCI, or equity method. Depending upon the policy adopted by the entity. In the consolidated, SOFP, a single line item for the investment in joint venture to be shown as under cost of investment, cash, loan notes, add share of post acquisition reserves. So how much cash have you paid? 2.5 million. What is the fair value of the loan note? That's 1.3 million. Add the share of post acquisition reserves. So what actually happens is that it has to be 0.8 million multiplied by you acquired on 1st July, right? And we're talking about a year end of 31st March. So that means multiply by 9 divided by 12 multiplied by 30%. Okay. See, what happens is that loan notes with a nominal value of 1.1 and fair value of 1.3 million. So we always record the investment at the fair value of, we always record the investment at the fair value of the consideration paid. So the fair value of the consideration paid was 1.3 million. It was not 1.1 million. So there was actually a loss, and the loss is going to be accounted for like this, 3.62 million. With respect to in the consolidated SOCI, a single line item for the share of profit/loss of joint venture to be shown as under loss from joint venture. So this is what you are going to do with respect to the associate. Do you get it now? It's just equity method of accounting, simple. I mean, it's simply equity method of accounting. Now, let's move a bit forward and let's move on to, okay, zoom out. Okay, I'll just zoom out. Or do you want me to zoom out further? I don't know how will it be visible if I zoom out further, but still, let's just see if you can capture it. I don't know. Okay, yeah, that's what I was just thinking, that it won't be visible, but I think now it's gonna be visible. See if it is visible now. Okay, is that okay now? Okay, now let's just go ahead. Take 5 minutes, try to do this batch, this number 3. Try to do this number 3, take 5 minutes. Okay, now let's just see. It says that on 1st January 2009, a Sterling company announced a plan to dispose of batch company, which operates in a significantly different business sector to the rest of the group. So they've decided to dispose of a subsidiary. Sterling first acquired 70% of the equity shares in batch company on 1st January 7 for a consideration of 3.1 million, when the fair value of the identifiable net assets acquired was 3.6 million. The ordinary share capital and retained earnings were this, and this respectively. So that means when you acquired this, the fair value was this share capital. The excess of fair value of identifiable net assets was due to a building. Fair value of NCI was 0.9 million, so and so. At 1st January, batch company retained earnings of 2.9 million with no change in ordinary share capital or impairment of goodwill since acquisition. Sterling decided to treat batch company as a disposal group held for sale in accordance with IFRS 5. So and so. With batch company require no remeasurement to applicable IFRS prior to restating as a disposal. The total fair value less cost to sell of the disposal group was estimated to be 4.4 million. Now, the requirement is that how exactly are we going to be accounting for this batch company? So it says that using exhibit number 3, explain how this is going to be accounted for. Now see, so let's just try to understand this. It says, using exhibit number 3, explain to the directors of a Sterling company how to account for batch company as a discontinued operation at 1st January 9 in accordance with so and so. Your answer should include a calculation of goodwill and how the investment in batch should be measured prior to disposal. Now see, so basically the first thing is that to calculate the goodwill, cost of investment, the cost of investment is basically 3.1 million. Fair value of non-controlling interest Fair value of non-controlling interest is 0.9 million. Fair value of net assets is this. So let's say that share capital, retained earnings, fair value, adjustment to the buildings, and so on, so on, so on. Share capital was 0.5 million. The retained earning was 2.1 million. The fair value adjustment is so 1 million was the fair value adjustment. Hence, the goodwill is gonna be 0.4 million. Goodwill at acquisition. Now, carrying amount of investment at the date of disposal slash classification as held for sale. The net assets is at the date of acquisition. So at the date of acquisition, the net assets were 3.6 million. Share of post acquisition retained earnings is going to be 2.9 minus the 2.1 multiplied by 70%. Share of excess depreciation it's gonna be minus 1 is the fair value adjustment. 10 years was the life. Divided by 10 multiplied by 2 multiplied by 70%. So hence the net assets would be shown like this, 4.02. The non-controlling interest would be shown like this. NCI at acquisition. NCI at acquisition is this. Share of post-acquisition retained earning is gonna be what? It's gonna be 2.9 minus 2.1 multiplied by 30%, and this is gonna be minus so it has to be spread over 10 years multiplied by 2 multiplied by Hence, resultingly, this is what the NCI would be shown at. So the question's requirement is that explain to directors how to account for batch as a discontinued operation at 1st January 2009 in a Sterling Company's consolidated financial statement. So what would happen is that okay, so we have been able to calculate that this is what the non-controlling interest is going to be at the date of the classification as held for sale. So now what happens is that since this will be classified as disposal group, a gain/loss on disposal is to be recognized. The subsidiary should not be consolidated further. The assets and the liabilities of the subsidiary to be shown as disposal group held for sale. The gain/loss on disposal is as under. Net assets is 4.02. The goodwill is gonna be 0.4. Non-controlling interest is 1.08. Hence 3.34 is the carrying amount of the subsidiary. The fair value less cost to sell is 4.4 million. Hence the carrying amount is already lower. Therefore, no write down is required for classification. Carrying amount upon classification as held for sale shall be as under. Now what I'll do is that I'll just go about this area. You can take a screenshot of the goodwill calculation. Wait a bit. You can take a screenshot of the goodwill calculation. See how we establish the net assets. Then see how the non-controlling interest would be considered and that there is no write-off. There is no write-off. Okay, does anyone have got any questions in this, please? Do you have any questions in this? Yeah, do you people have any questions in this? Okay, so we are done with this specific question that was about the consolidation, and that was basically one of the past examination question. I hope that this question would have been clear to you people. So the name of the question was Sterling Company.